Welcome to the Top M&A Entrepreneurs. Today, my guest is Jason Neimark. Jason is managing partner at and co-founder at New Water Capital. He's worked on over 65 buyout and capital market transactions in his career. He used to work at KPMG, and he went to Indiana University. So welcome to the show, Jason.
Thanks for having me.
Yeah.
Great to meet you by video.
Yeah. So let's talk a little bit about what you do at New Water Capital. I'm reading it's a $406 million private equity fund. That's an interesting number. Why not 400? And you look for lower middle market deals, 30 to 300 million in industrial manufacturing and services, consumer products, and retail. And I got to ask you about the consumer products when you're talking about, is that food related products and retail? So tell me a little bit about how that started, New Water Capital.
Well, I'll back up a little bit. Sure. So from Chicago, went to Indiana University, and I did start out in public accounting as a CPA at KPMG doing audit and tax work. And then I jumped on the balance sheet, as we like to say, and moved into mezzanine financing at a group called Midwest Mezzanine Funds in Chicago, doing subordinated debt and equity. Being part of that, I did a transaction with some folks in the private equity world, and then made my way further down into the balance sheet into private equity. So from 2001 through 2014, I was at Sun Capital Partners, one of the first people there, sourced and led over 40 transactions there. We grew from no fund to having $10 billion under management. And from a going back to my roots standpoint, that's where New Water Capital started. So myself and Brian McGee had been at Sun Capital for a number of years. Brian worked for me, great principal. He worked out better as a partner. So we wanted to go back to our roots instead of doing these large transactions, to go back to the lower middle market. And that's where we started New Water Capital, dealing with the size companies you were referencing, which I can give you a little bit more flavor into our investment criteria and our thought process. But in 2015, we raised a $406 million fund. Yes, it was an odd number, but it just had to do with some of the demand that we had, and also raising new funds, as you can imagine. So we have over $500 million under management currently, but all in these lower middle market companies.
Yeah, so let's talk about that process of bringing an idea together and saying, hey, we're going to acquire a number of companies between 300 and 300 million. You create the pitch deck or whatever, and then you start knocking on doors, institutional investors. What does that look like?
So from that perspective, if you go back in time, the good news was I had a lot of experience. So I had sourced and led over 40 transactions in the middle market and lower middle market private equity space. So I had a track record from that perspective. And when you start looking at the track record and you look at the focus area that we wanted to focus on, which was lower middle market, most of my track record was there. And what we do here at New Water is we do invest in consumer products and industrial manufacturing and industrial technology. We haven't invested in retail in quite a while, just because the retail arena is quite volatile, as you can imagine. Yeah. But within consumer products, what we look for are companies mostly that are contract manufacturers. So we're not the brand builders that you see out there within the private equity world. What we like to say is we're the custodian of these multi-million and multi-billion dollar brands. So for example, on the consumer product space, we have an over-the-counter pharmaceutical business called Trillium Healthcare. And Trillium Healthcare is up in Brockville, Ontario. What they manufacture is for all the large CPG companies. So think about your P&G, think about your J&J, your Pfizer, your Church & Dwight, big brand houses, but they don't want to manufacture anymore. So we manufacture. If you opened up your medicine cabinet, I would guarantee you have something. Your Tylenol, your Benadryl, your Sudafed, your Prep H, your Nizoral dandruff shampoo. We produce these products for these large CPG companies because they are specialized products, and we let the brand houses then market those products. So if a brand house were marketing a product and they spent $5 million on a new introduction of Robitussin. So for instance, we did Robitussin all natural honey and Robitussin with elderberry. Well, we, as a small private equity firm, wouldn't put those type of resources and dollars behind it. But what we do have is top-notch manufacturing facilities with high quality. And the reason I say we're the custodian of these multi-billion-dollar brands is we have to put quality first. And quality is important because we cannot have a recall on Tylenol. We can't have a recall on Sudafed or Benadryl, etc. So we have to put quality first, on-time delivery, and great production in terms of our assets. So if you really
let me ask you about that Trillium Healthcare.
Yep.
Do you build, because when I go to CVS and I buy Tylenol, I'll just look for the white label Tylenol because it's the same ingredients, just $4 cheaper.
Similar. Yeah, it depends on where you're getting it from, who's manufacturing it. So we do not do private label. We used to do some private label up in Canada. And a lot of times people say, oh, it's always all made in the same factory. At least that's what I try to convince my wife.
That's what everybody says when they want.
Exactly. When I want to convince my wife to buy the cheaper brand, I say it's made in the same factory. But I do know that it's not. So from a private label perspective, that's a different category. A lot of times they're imported products, and they're getting them in mass quantity and they're packaging them in the United States. But for the North American and global brand builders, they want to make sure that they have that top quality manufacturing facility that meets all of the FDA, Health Canada, USDA regulations that are really important to their brand at the end of the day.
Yeah, let me ask you about the types of companies you target. You say on your site, companies in transition, growth challenge, succession issues, need of sophisticated partner, underperforming businesses, carve-outs, turnaround situations. Did Trillium fit in that? And how did you find the lead?
Sure. So we found it from an investment bank. It started out as a broad process, and it was a carve-out. So it was tucked under a $400 million personal care soap product business. And this was a little bit of the stepchild business because it went through some transformation over the years to only focus on OTC. They did no marketing. They didn't have any marketing talent within the organization, and they had a huge customer concentration with Johnson & Johnson. And that customer concentration was about 80%. So if you're a private equity firm, most private equity firms open the book, they looked at it, saw the customer concentration, threw the book out.
Right.
Well, we like to peel back the onion a little bit more and understand it. So when we started peeling back that onion, we recognized that of that concentration, as you know, a lot of these pharma companies come together and consolidate. So you had Johnson & Johnson US Consumer, Johnson & Johnson Canada, and McNeil. So when you had these three different divisions, they really comprised the breadth of the mainstay of their portfolio. Two, it takes a very long time to transfer any one of these products that have an active ingredient in it, so some type of acetaminophen or pseudoephedrine. You can't just pick it up and move it from plant to plant. So they had a very sticky customer base. They never lost a customer to a competitor.
How long is it? Curious, what does that number look like to say, you know what, you guys we're going to move it to a new manufacturing plant. That would take more than 12 months.
2 years.
2 years. Yeah.
2 years. So unless, like I said, unless you have quality issues where they start thinking and investigating the move and transfer, as we call it, it's very difficult to transfer. So that's why, from a quality perspective, 1/3 of our entire workforce is in the quality department, because you cannot let a product come into that factory, go through the processing, or leave that factory with any quality issues because of the recall risk.
Highly regulated. Yeah.
So
how long is the contract with? 88% of the revenue comes from one customer. How long is that contract with them?
So the contract is not really more of it's really more of a volume contract that you have with a lot of the customers, and then it's on a PO base. But what we did here was we saw that as a nice base, whereby then we could build out, because they'd done no marketing at all, and we saw they had a good pipeline going, where we could start building out and diversifying the customer base. So if you fast forward from when we bought that company, I believe it was 2017, till today, the business right now is trending towards less than 35% J&J. So with that being the case, we built off of the base of this Johnson & Johnson, where it's a very sticky customer base, and then we're diversifying down through other customers such as your P&Gs, your Pfizers, your Church and Dwight's, all the large CPGs of the world. So that's really what we did in terms of execution. And we're very hands-on in terms of helping with the operations. So we did build out the management team. We expanded their facilities. We invested in technology. We invested in research and development, which these guys never had before. So the customers would come to them and say, I need this. Do you know how to make it? And we would say no. But now we can say we can. We can help you formulate a new product. We can help you develop the new product, get it through the FDA. The good news is we're not making cancer drugs. We're making over-the-counter pharmaceuticals that have a much shorter lead time when it comes to development.
Yeah, let me ask you about the the process. You see this opportunity, 88% concentration. Lots of people just say no. The risk is too high. What kind of valuation did you see it, and was it discounted? And what's the valuation look now that you have 30? That your biggest customer has 35. How's that change the valuation?
Yeah, so the valuation was mid-single digits, and comparable businesses in this space with the diversification and growth are trading in the mid-teens. So a lot of value to be created from that perspective, but a lot of heavy work that needed to be done, both from a new customer development, from an R&D perspective, and then manufacturing. So it's not easy to ramp up the growth that significantly within a portfolio company. And that's what we deal with. So as you think about these lower middle market companies that are in transition, right? So whether it's a family-led business that's transitioning out, or these corporate carve-outs where, again, transitioning again, they tend to be underperforming to their peers. So you look at they're unsophisticated a bit. They lack depth of management. So you may have a great president, or the founder may have been a great CEO, but below that person, there's typically not that much depth to an organization. And that's where we, as an organization, need to supplant them. And we need to help until such time as we can build their team around them. So we have those resources internally to do that heavy lifting. And that's why we were so interested in the lower middle market, because you can create a lot of value, as you pointed out, by buying it at a discount when it has some scratches and dents, enhancing value, and then selling it in the future. So that's really what we do. And you'll see that. Go ahead.
Did you replace management? Because normally it's like in that situation, it's is the management coachable to be able to see this future that you have envisioned for them?
Some, yes. Some we had to replace. Some we just had to put in the right seats. So some people just happened to be in the wrong seats within the organization. So we did move them. We did bring on some new team members to help lead and run the organization. So it all depends on what you have and what you have to harness. But we prefer to keep that institutional knowledge and build around them with others who are also equally as strong, if not stronger. So it really depends on the type of situation.
Yeah. How do you measure that? Do you say, I'd love to keep you on board? Because if the guy's a 400 hitter, as Warren Buffett says, I don't tell 400 hitters how to bat, right? They know what they're doing, but maybe it's because they were under a bigger company who kept them on a short leash. Now you say, how long do you give them to say, this is what we envision, we got to diversify, we're going to do this? How long do you give them before you say, well, okay, man, you got to go?
Yeah, it's one of those, it depends. So we do a lot of analysis beforehand, both from a transaction perspective and then from our operators going in there and assessing. One of the neat things we do from an operations perspective is called skip level interviews. So instead of dealing with just that C-suite of individuals, we go down a layer. And that's where you really find out a lot of the hidden secrets of the organization and where the improvements can be made and who's good and who's not good at the end of the day. So we do take our time. We're trying to be thoughtful. Unlike you hear a lot of times in private equity, oh, everybody's so stupid. They're not so stupid. They obviously got here and built a 60, 80, $100 million company by doing something right. So let's harness that talent that they have and let's figure out how we could augment them. And as I said before, a lot of times it's getting the right people in the right chairs. And once you do so with the proper leadership, you can really make a lot of change in a short period of time. And we always have the saying internally is like the first 50% is almost free, because a lot of that change comes from inside. When you do those skip level interviews and you start talking to the people on the shop floor, a lot of the ideas to change and improve the organization, they're already
Are
there.
right there. They're already there. Yeah.
Yep, exactly.
Yeah. How long do you give yourself to turn it around? I mean, is there you don't make any changes for 100 days or 6 months or what?
Well, it all depends on the situation, right? So depending on the situation, some turnarounds, or I'll call it improvements, because not all of them are turnarounds. Some of them are improvements.
Was this business profitable?
Yes, it was profitable.
Okay.
Yep.
Yeah.
So it was profitable. So I wouldn't look at this one as a turnaround as much as it needed some direction, strategic planning, getting the right people in the right place, and helping with our manufacturing capabilities internally to really augment their processes. So it really does depend, and you have to look at each one individually. So it's almost like having kids, right? Not all your kids are the same, even though they all came from you from the beginning, and you have to treat them as individuals at the end of the day. What worked for my oldest one doesn't really work the same for my youngest one at the end of the day. So we do have to be very cognizant and thoughtful about that.
Yeah. How did you buy it? Now you raised $400 million. Was that in committed equity, or was that debt and saying, hey, whatever you got to do, we'll put a debt? And what did that look like if you're buying something at 1.5x?
Yeah, so the way our deals work in our fund works is it is a committed fund. So universities, endowments, public and private pension funds, family offices, fund to funds out there. So it's a committed fund. And then what we do is we go out and find transactions, and then we structure transactions based on putting in the appropriate amount of debt based on the industry, the situation, how much liquidity they need, and then how much equity we can put in to generate a return that we find acceptable at the end of the day. So once, as is every private equity firm, once we do find the opportunity and we close on the deal, we call the capital from our committed capital investors, and that's how we fund the deals at the end.
Yeah. And why were they selling that? Why was the larger company and investment banker reaching out to you, or you reached out to them?
Yeah, they were actually part of a family office that thought that they wanted to do direct investing, and then they realized it was a little bit more hands-on and difficult to own these companies individually than it was to own them through a commitment like they would
put your money to work, right?
Correct. So they own this business, and like I said, it was tucked under the business that it shouldn't have been in, which was a personal care business, and they were divesting all of their direct holdings. And when they did that, this was actually one of the last ones within the portfolio. So with that being the case, we were the beneficiaries of this great opportunity that we saw.
How fast do you move on that? You say you get an opportunity, you ask for, the data room, you look at the financials, balance sheets, everything. How fast do you move on this? Say, hey, immediately it's passing, there's no red flags. Let's make an offer on it.
Yeah, we're pretty nimble in terms of processes internally. And if we see something that makes sense for us and we think that the numbers work out and we can peel back that onion a little bit more, we'll move pretty darn quick. A lot of times it's dictated by the investment banker and the process they're running. So investment bankers will have a pretty stringent process where indications of interest are due 30 days after the teaser and the book go out. Then they go to the next stage, which is a management presentation for those who made the first cut. After the management presentation, they let you in the data room. And then after the data room and you get follow-up phone calls, et cetera, then they ask for a letter of intent. So on average, a process from the time that if we're selling, engage an investment banker all the way through the process could take 6 to 9 months. As a buyer, it typically takes somewhere around 3 months, just based on the fact that there is a timeline to the way that the investment banker set everything up.
To your knowledge, were you competing against any other buyers? Or,
Sure.
the investment bankers were, use you as leverage for moving the offer up or out. Yeah,
it's like buying a house, right? There's a lot of interest.
I've got a lot of interest. I got 3 other offers on the table. You want to get your LOI in at the end of the day.
Yeah, listen, that's their job and they're good at it, right? That's why people hire investment bankers, and that's why we hire investment bankers to sell our companies, because it helps with the competitive dynamic out there. If you're trying to sell a company one-off, well, the buyer knows that you're the only game in town at this point in time. So with that being said, they feel like they always have a little more leverage. Whether they do or not, they're going to be cute about it. So these competitive processes definitely help keep everybody a little bit more focused.
That happens on every economic level on that buying.
Right.
So these companies you buy, like Trillium, how long do you keep them? Because this private equity money has a 5 to 7 year turn rate on it.
So fund lives typically are 10 years with some
10
extensions that go along with them. However, I think a general rule of thumb for us is we hold companies 3 to 5 years. And that also depends, right? So it depends on what the transformation process is, right? How quickly you think you can accelerate that process. But a typical time period in terms of from the time you buy it till the time you should be getting it to that point of I'll call it stability and growth that you can go sell it is probably at least 3 years.
Yeah.
Sometimes you get the lightning in the bottle. On the other hand, sometimes you have acquisitions and integrations to do that take 5 years or 6 years or even 7 years. But you have to re-underwrite these things every time you do something new.
Yeah. And do you have an investment banker on staff to help you sell the company, or does you outsource that to somebody else?
Yeah, we outsource it. So what we do is we look for the expert in the industry. Typically, the person that sold it to us will be involved in the bake-off, as we like to say. So we bring in typically anywhere from 3 to 5 investment bankers who have expertise in a certain category. So whether it's over-the-counter pharmaceuticals, to food, to printed circuit boards and EMS, to automotive, there are different investment bankers that specialize in different categories. And we figure out who, number one, size-wise and expertise, has the expertise in our area. And then we bring in them to pitch us and say, well, how are you going to pitch our business? How are you going to position it in the market? And how will you maximize value at the end of the day? And then that's where we pick from. But we don't have anybody internally, but most people within our organization have been ex-investment bankers.
And how do you guys rate that, like signing up an investment banker, like number of transactions, money, making sure that they find a home that's a great cultural fit, et cetera? How do you rank those?
Yeah, it's a lot of different factors. So when you start thinking about it, first you got to have the industry expertise. So if you're looking to sell a pharmaceutical business and you're mainly a furniture banker, probably not a good idea. So
that's like, I have a friend calls like, look, if you're going to get brain surgery on your kid, you want somebody that's done a lot of brain surgeries? No.
Yes. Yeah, or you don't want the guy who deals with orthopedic on your ankle to do your brain surgery, right?
Yeah.
That just wouldn't make sense. So expertise within a certain industry category is important. Size is also important too. So when you come into a situation and you can have an investment banker, say from Goldman Sachs, and they're doing multi-billion-dollar deals, but if they don't know the market for the lower middle market, which may be $100 to $300 million deal, that's also very difficult. So you got to really be thoughtful of not only expertise, but size. That's very important. Then also how they position it. And we don't want to give them the answer at the end of the day. So they need to look at our asset, and we give them a lot of data, but they need to look at our asset and say, how would they position this company to the market? And we're trying to get a good understanding of who the potential buyers would be, how you'd position it to them. Would you position it differently to a strategic versus a private equity firm? Who are the likely suspects at the end of the day? Give us a list of who you think you're going to go to. So there's a lot of different factors, and we want to hear how they pitch the story, because at the end of the day, you need to be articulate. And if you can't articulate our story to us, how do we trust you to articulate it to somebody else?
Yeah. As any of your portfolio companies, you turned them around, you increased the valuation, hired an investment banker, and they put it in the wrong home? Or do you kind of care about that after it's gone?
Yeah, well, it's not so much. Listen, we're very close with our management teams. We're a very people-oriented business within our institution here at Newwater. So our management teams are used to having a very strong working relationship and close relationship with our teams. So we are thoughtful about where the companies go at the end of the day. But you never know, right? Everybody says the right thing when they come in, and they're going to treat your baby well, and they're going to do all these, they're going to invest, and they're going to look at new opportunities to help grow the organization. But quite honestly, do you really know at the end of the day? No. The
No.
neat thing about investment banks is they have these sponsor coverage groups. So these sponsor coverage groups tend to deal with a whole host of private equity firms out there. So they can give you insight into whether or not the person that you're selling to is a good buyer. Not only a good buyer for the future of the company and the management team, but also how they can interact with us when we go to sell with them. Are they going to retrade us? Do they have a history of retrading? There are firms out there, believe it or not, that are known to be retraders at the end of the day. So the investment banker, if they have a good sponsor coverage team, can give you a little bit more insight into.
Well, explain that retrader.
So a retrade is when someone says, okay, great, John, I'm going to buy your business for 10 times, $10 million in EBITDA, and we're really interested. We did a lot of work, and they give you a lot of confidence that they have $1 billion fund and no problems at all, etc. Well, all of a sudden you get this confidence in them that they sound like, and they appear to be such a good buyer. Oftentimes what happens is you then sign them up because they had the highest bid, but then during the process, they start nitpicking based on all these things that they were supposedly supposed to know, and they retrade you down to a lower price. And some is warranted.
Oh, yeah. Okay, gotcha. Yeah,
for sure, right? Some is warranted, right? They open up the hood and they go, wait a second, you're missing a carburetor, your timing belt's off. I got to fix this. I got to fix that. But other times it's not. They just bid high to lock it up, and then they retrade you to a lower price later because they already know they have you under exclusivity. So, it's important to, like, we're going back to the investment banking discussion. It's important to have a bank that can represent you well, keep the competitive dynamic, and understands the buyer network. So it's almost like a realtor,
And you're in a couple of different markets here: industrial manufacturing, consumer products, and retail.
Yep.
Now, are you at a point where you're using the same investment bankers over and over again because they have expertise in that?
We see a lot of the same bankers over and over again on the buy side, but we tend not to exclusively use the same bankers on the sell side because the investment banking community moves around a lot. Yeah. So your original banker could have been at Lincoln, and now he's at Baird, or then he went over to Harris Williams, or who knows where they went at the end of the day. So you just have to be thoughtful about having them repitch, as we like to say, on the opportunity later on.
Yeah. Let me ask you about the communication and interaction between the funds where you get your money. Do they, you have a $406 million fund. How are you supposed to required or obligated to communicate with them about, hey, we're going to make this $30 million investment in a, Trillium, let's say, we're going to purchase that. We're going to do this, this, and this. And, what do they say? It's like, oh, great, go do it. Or do they have veto vote or what?
No, it's completely to our discretion. So just like we do diligence on companies before we purchase them, the LP investor world does diligence on us, our track record, our strategy. It sounds very similar, right? So they do that, but it's a pool of committed capital that we have discretion over at the end of the day. So we make the investments with our investment committee internally without consultation of our limited partners. And our investment committee, which is what our investors like, are both transaction backgrounded folks and operation background. So you take the operations and the transaction people, and they're on the investment committee because you get a dual lens into these companies from different backgrounds and perspectives. So what we do is we do communicate quite often with our investor base, telling them about what we purchased. We do quarterly valuations. We tell them about the performance of the portfolio companies. And then every year, as is customary in our industry, we do an annual meeting. And we just had our annual meeting with our investor LP base, where we then update them on every portfolio company in depth. And then we also have our management companies come in and present. So not only are you hearing from Newwater as to what did we buy, how's it going, but you hear from our management team as to how's it really going internally, what are we doing and what's our strategic direction.
Yeah. And now Trillium sounds like a great success story to brag about. Was there any acquisitions you made where the ideas, strategies just didn't work out? Yeah, like it didn't work out. We have to unload it. It's just not
Sure.
working. Yeah.
Yeah. No, listen, we all have had these boogers, as we like to call them, or scars on our back.
I say this, like, I think the reason Warren Buffett gave the name Berkshire Hathaway was to keep himself humble, because that was a textile firm that did not work out and he had to unload it.
Probably so. And you know what? It makes sense, because as we say, you can't see the scars on our back, but you seem to learn more from the deals that didn't work out than if things are all going swimmingly. So yeah, we've had companies that haven't worked out. You mentioned the retail sector. We haven't invested in the retail sector since 2016. We did have a direct and consumer women's apparel business back then that was in-home consultative selling. And that's a difficult business to be in, especially during COVID, right? So imagine a one-on-one sale of high-end women's apparel during the COVID era. It doesn't really work out. And also there's been a lot of volatility and change within the retail area. So think about where the transition's gone from bricks and mortar to online. Used to pay for shipping, if you recall, back in the day, to now everything's free shipping, free returns.
So you get charged for sales tax, though. Yes, and sales tax.
Well, that's a government issue. That's a different issue than anything else. But yeah, there's a lot of dynamics that don't work in certain industries, but you have to have an internal model of continuous learning. So if you're not continually learning and being thoughtful about where different industries are working and not working and different companies are, you're not going to grow at the end of the day. So we always have a saying internally that we can fix a bad company, we can't fix a bad industry. So if an industry is not doing well and the dynamics are going against you, we with a little $60, $100, $200 million company aren't going to change the industry dynamics at the end of the day. So we need to be thoughtful about that.
Yeah, you got a couple Klosterman. Ask you about the food industry. You've got Klosterman Baking Company, the Perfect Bite, and Pegasus Foods. What's the attractants to food-related products?
Yeah, so everybody eats food, right? So everybody eats food.
That's not going away, right?
Yeah, that's not going away.
But it's very fickle.
People are fickle, right? People are different. But Klosterman's a great example, a 130-year-old, fourth generation family-led business that wasn't going on to the fifth generation, and the fourth generation was looking to retire. So they were looking for a great place and a good buyer to acquire the business and really bring it to the next step through investment, taking care of the employees, because they view the whole employee base as their family. They're out of Cincinnati, Ohio. Great business. They're making buns and bread and donuts. So think about McDonald's, Chick-fil-A, Raising Cane's, Kroger, your institutional sales such as your schools and your prisons and your nursing homes. So bread is a staple item. Great customer base, 7 bakeries. And when we invested in it in July of 2022, well, nobody knew where the economy was going. Are we going into recession? Maybe. Inflationary environment? For sure. Well, we wanted a really nice, stable asset. And bread is proven through multiple cycles to be that stable consumer non-discretionary asset that actually grows through recessionary periods of time. So from a macro perspective, we really like the opportunity because it had a nice base to grow off of. And, QSRs, which are your quick service restaurants, they also tend to grow during these recessionary periods of time. So we like that from that perspective. And then it's a transitionary family-led business that, once you start professionalizing it with private equity, there's a lot of upside opportunity. So we saw a lot of good dynamics there.
Was that founded in 1892? And were the family members still running and managing it, or did they have professional management?
They brought in professional management approximately 10 years ago, but the one family member was still the CEO and head of the board. So he still had his thumb on the company until such time as it sold.
Was that a company that kind of met your criteria that you look for, or was it a turnaround, distressed kind of situation, or was it just profitable?
Yeah, it was a
available.
nice transitionary underperforming business. So a lot of upside. And when we say underperforming, we look at it as where are your margins compared to your peers? And if your margins are below your peers, we'll call it underperforming. But they did have nice profitability to build off of, which is what we also like. So it wasn't a bleeder, nice business, great team of people, a lot of depth within the organization. But they had some room to improve. Listen, when you own a company for 130 years and you see things somewhat the same way, there's always room for improvement.
Right. So that strategy and those ideas, like Trillium, to see the opportunity with a high concentration of customers, is completely different than saying, "Hey, your profit margins compared to your peers is lower. Here's our opportunity here." How do you focus on that and say, "Okay, here's the 3 things or 5 things we're going to do to this company, and this is what it's going to look like in 5 years or 3 to 5 years"?
Yeah, so we bring together, like I said from the beginning, we bring together an operational and transaction focus. So we look at the business if you look at Klosterman, for instance, or if you look at Trillium, you look at the base business that's there. Is it stable? Is it in a category that is stable to growing, which we really like? Or is it in a declining category, which we don't like? So if we have, whether it's a turnaround, an underperformer, or even a somewhat just stable transitionary business, we need, from a macro perspective, for those boxes to be checked. And if you look at each of those companies, if you look at over-the-counter pharmaceuticals and you look at bakery and bread products, both of them are growing industries that have a good, stable base. So we like that. And there's a great macroeconomic factors that are giving them good tailwinds. Then we start peeling back the onion and looking at the operational challenges, if they're there, or some of the situational challenges, if they're there. And we start looking into those and saying, what is it we can do with this business? And a lot of firms are mostly, smart, financial backed people who have transactional backgrounds, such as investment banking. But what we do is we take a different approach. We bring our operators into the companies immediately and say, if we believe we can enhance margins by X, Y, or Z, or we believe we can do this operationally if we change around the flow of the facility and we can open up capacity, does that seem realistic? And we both do our math together, and then we come to an answer of, here's the plan that we believe we can execute on in order to enhance value at the end of the day. And some of it may be strategic planning, all the way through customer SKU analysis to operational improvements. One of the things that we do at every company is a customer and SKU analysis. And what I mean by that is oftentimes businesses over a number of years have accumulated more and more and more customers.
Yeah, a product line that's not making any money and it costs more than it.
Yeah, exactly. And so we need to look at it and do that SKU analysis to determine, hey, we may need to either raise prices, eliminate a customer, and or eliminate a product category or SKU. So it's a lot of heavy lifting and work and really dissecting it to really understand what is it you have under here.
Yeah, that sounds like, it's 1892. Sounds like it's a buy and hold. How was the conversation like, hey, we need to fix you and sell you in 3 to 5 years,
Yeah, that really wasn't the conversation. It was more, hey, we're gonna flip it, and I don't know if flip it's the right word, but we're gonna help.
I don't think a 130 plus year old company goes, we don't want a new owner in 3 years.
Yeah. What they were looking for were people to come in and invest in the team and the facilities, because they understood that the facilities were underinvested and they needed some more depth to their management. And so that's what they were looking for, was a hands-on partner to come in and really help them effectuate that change. Clearly, they were looking for price, but the brand within their community was very strong. So they wanted to make sure there was a good steward of the brand in that Midwest Cincinnati area to make sure that things were going to go well, because there are a lot of people within that area that belong to that business. So you're going to see them around town. You're going to go to the local coffee shop and you're going to see and run into the former family of this organization. So they were looking for a good steward who would invest and take care of the people. And we were able to demonstrate that through our operational focus.
Yeah, let me ask you a little bit of questions about you.
Yep.
Where do you go for advice, mentorship, to and inspiration to keep going doing this?
Yeah, it's interesting. So it's one of those things where there was back in the day. So we'll go back to my accounting days, and this will be a commercial you remember. There was a guy at the Dunkin' Donuts commercial who would get up every day, and it was time to make the donuts.
Gotta make the
If
time to make the
time to make the donuts, and then that commercial would keep repeating every morning, and that's what he would get up, and he looked terrible, and he wasn't happy. Well, you know what? When I started out in public accounting, I felt like after 4 years, it was kind of time to make the donuts, and I needed a little bit more. And I had a passion for investing, looking at companies, looking at the challenges and opportunities there, and that's why I started getting into the private equity arena. These days it'd be very unusual for someone in public accounting to jump into private equity. There's more inclined for people from investment banking on the transaction side to get into private equity than they are from public accounting. So I was pretty fortunate back then. Actually, if you look at where a lot of my inspiration of improving and growing comes from, it comes from the leadership within our portfolio companies, because you can learn a lot from the different leaders we have within our different portfolio companies. Everybody has a different style and approach and things that they've seen in the past. And if you listen to them and all the people, as we talked about those skip level interviews below them, you can really understand different ways to enhance value, different ways to see things that you may not have seen. And that's really where it comes from me. I've learned a ton, not only from our operators that we've brought on internally at Newwater, who have been in the chair, as we like to say, of these of companies out in the market, but from companies that we've acquired. The management teams have a lot to offer, and they give you different perspectives, and we all learn from each other at the end of the day. We're not prescriptive. We're not ones who say, you must do it this way, go execute. No, that's just not what we do. It's very collaborative. And really, that it's inspirational, really, at the end of the day, to see them grow and see us grow and see our team grow.
Yeah. Have you ever done one of these skip level interviews or higher up interviews, and you go, it's like, man, we did just not jive together. I got a weird feeling about that. And then you have to do something later, or you just ignore it because he's doing a great job.
No, listen, I'll give you a couple examples. We've done some skip level interviews where, company not to be named, we did skip level interviews, and, there's posters everywhere around this company saying how they're so family oriented and everybody's family. And then we start looking at some of their safety records, and we're like, that's odd. But we didn't know exactly. So when we started doing the skip level interviews, we recognized there were significant safety issues within their factories, and they needed to be addressed. And quite honestly, at the end of the day, they weren't treated as family, or if they were, they weren't, the best. They were probably the redheaded stepchild that wasn't treated nicely. But, we recognized that those safety issues persisted at a whole bunch of different levels within the organization. So what we did was we actually hired a director who was the head of safety, and we made sure that everybody came to work and left work in the exact same condition. And safety was a top priority, because you got to take care of your people first. And what the company before said is you got to take care of the customer first at all costs. Well, they flipped it the wrong way. If you take care of your people will take care of your customers. If you don't take care of your people, they can't take care of your customers, and it will show to your customers the culture that you have internally.
When did you make that change? Like, it used to be customers always right, to, take care of your people.
We've been doing that for a long time, because we recognize that's how business works. Yeah, listen, it's important to take care of your customers, but you can't take care of your customers unless you take care of your people. And so that's been a mantra here for a long period of time, and that's why safety was such an important thing. And it was something that we had to move on very quickly, because it was extremely important to everybody in the organization.
Yeah. Do you have mentors, and what's some of the best advice you've received throughout your career that just stays with you? Like, it's ingrained.
That's a good one. You know what? It's really, I'd say from a mentorship standpoint, it's the people I've worked for before, and a lot of them has been different personalities and different ways of doing business. And sometimes people say to me, they go, "You talk with this one and this one, They're completely different types of people. Yeah, but it doesn't mean you don't learn a lot from each one. And you could take the different pearls of wisdom from each one and apply it to who you are as a person. So I think one of the big things that I've taken and we utilize a lot within our organization is we help others learn to see things that they may not have seen themselves by listening and not trying to always be, as I mentioned before, prescriptive about we're the smartest guys in the room, because a lot of people have things to offer and value to add. And to give people that opportunity to add value at the end of the day gives them a lot more success. And then if you feel you have a career path and you can grow, people will work a lot harder for you. They'll put their head through a wall for you because they know that you're on their team. So yeah. I think that's really what it's about at the end of the day. It's not rocket science, but it's important to us to make sure that, we value the people.
Is that would you call that a win for you? Like
which part?
Like the part where people are, going above and beyond what their normal capabilities, and because you're behind them, you owe it to them. Yeah.
Yeah. You know what? We look at when people get promoted, we're cheering them on. And at the end of the day, to give them a career path opportunity and see them monetize and win when we ultimately get to the path of sale, that's important to us. So when we have sold companies in the past, we didn't only compensate the senior management team. We went down to the supervisors and the line leaders. We wanted to make sure that everybody who contributed within the organization recognized that we recognize them and they should benefit from all the hard work too. It's not just the magic of the CEO and the CFO and the COO at the end of the day. There's a lot more support within an organization that made us all win. And we changed lives. I mean, there were certain people, you could have been a supervisor and you got a $25,000 or $50,000 bonus. We had people coming up to us telling us how life-changing that was. They went and bought their first house. They were able to take care of their parents. So from our perspective and my perspective personally, to see others succeed, I think is pretty darn fulfilling.
Yeah. Let me go back to the operators. Now, you've been through a number of companies here. Do you find somebody that, wow, this guy is a great operator and he's with this company, but we'd love to tap him and bring him over here because, you like we all watch sports and they do that. He goes, man, that quarterback was great. I want him on my team. So you trade for him.
Yeah, listen, I've definitely gone out there and tried to poach some people that I knew were great. And actually, we have a great example. So our CEO and CFO of Klosterman Bakery were our former CEO and CFO of another food company. We all enjoyed working so well together. We had great success. We understand how each other work. And when we bought Klosterman, and they were done with their other opportunities, they came to us and they said, hey, listen, I know what you just bought and I know you guys are looking. This would be a great opportunity for us to work together again. We were thrilled.
And now they're on the cap table too. I mean, probably.
Of course.
Yeah.
Of course.
Yeah. Well, that's fantastic. I mean, what's next for you? You guys keep doing this for another. And I always measure this by like Warren Buffett, Charlie Munger. They're going to keep working until they're 90. I mean, they're room temperature. Like,
yeah, as you say. Yeah. So listen, I tried taking up golf. It's harder than I thought it would be. I don't have that many hobbies and there's only so much traveling you can do. This keeps your mind sharp. I actually like what I'm doing on a daily basis. Listen, I understand life is stressful and we have our own stresses internally here and every day's a fight, but we all enjoy what we're doing. I mean, everybody in this office, and you could feel it within our culture, we enjoy coming to work. We enjoy doing what we're doing. As things move on and as I get older and as the younger folks within our organization continue to grow, will I slow down a little bit more? I'm sure. And I'm sure that they'd want me to because they want to take on more responsibility. Yeah. So listen, we get the whole circle of life and we understand how the life cycle of an organization works. So I get it, but it'll not yet. I'm a little young still.
How many acquisitions you have planned for the rest of this year? I mean,
so we typically do 2 to 4 deals per year, depending on the market.
Yeah. And what does that deal flow need to look like for you to get to 2 to 4?
So we see probably 500 to 600 deals per year. So that's the beginning part of our funnel. And then, it ends up being 2 to 4 per year. So we probably do somewhere between 10 and 20 letters of intent go out at during the course of a year after we've done our work on some companies, probably average of 12 to 15. And then we close on 2 to 4 of them. So it's a selective process, but the funnel's big at the top. And then it narrows it way down.
Yeah. Deal flow. You can never get enough deal flow.
It's true.
Yeah. Great. Jason, thank you so much for being on my podcast. Really appreciate it.
Yeah. Thanks for having me. Have a great day.
I hope this video has inspired you. If you need help buying your first $1 million business, make sure to visit me at dealflowsystem.net. If you like this video, make sure you subscribe down below. Comment on it, share it, tell everyone about it. And thanks for watching.